Welcome to Fear and Greed Summer Investing Series, brought to you by Vanta, specialists in compliance-led growth. I'm Sean Aylmer. We're all about explaining jargon and terminology on this podcast, and that applies to investing as well. You might have heard of sum of parts valuations, a strategy for figuring out the value of a company. It's a great tool for investors, and today we're getting an insight into how to use it. As always, this is general information only, and you should seek independent advice before making investment decisions. Brian Hand is the Director of Equities Research Australia New Zealand at Morningstar, a great friend of ours at Fear and Greed. Brian, welcome back.
Hello, Sean.
Explain some of the parts valuations.
Sean, let's say you find a company or a stock that's really cheap, and then you look into it and you realize that this company is made up of several discrete businesses that are jumbled together. And then you think to yourself, hey, wait a minute, if all these companies were separately valued or separately listed, and for each business, there are comparable businesses now out on the stock market where the market is already attributing a value, then you will think to yourself, okay, what if I did a Richard Gere character in Pretty Woman and break up this company, spare parts by spare parts? Would the sum of those parts be greater than what the market is attributing value to this company? And that, in essence, is what sum of parts breakup valuation is.
So there's some easy ones to think of. WH Soul Patts, Wesfarmers, another one. So Wesfarmers, people know Officeworks, they know Bunnings, they know the chemicals business, there's fertilizer. So the sum of parts that I kind of get, you can very discrete businesses, but can you do it for another large company, maybe a bank? I don't know, because they've got insurance. Well, they have not so much insurance anymore, but maybe an industrial or something like that. Or is it just the big conglomerates you're talking about?
Oh, those are very good examples, Sean. But I'll give you a couple that's very close to your heart, Sean. Given your background, let's say Channel 9, Nine Entertainment. Now, when you look at this company right now, it's worth $2 billion on the stock market right now at current prices. If you take 60% of its shareholding in Domain, the property portal business, that's already $1 billion. So you're saying the rest of the businesses are worth $1 billion. Now, what if I asked you, Sean, Sydney Morning Herald and The Age, you can't sell that to some billionaire to use as a soapbox for $500 million? I think you can. What about AFR? You can't sell that don't tell me you can't sell that for $200 million to some private equity person and seduce him with the demographic of the readership, and especially in Australia where there is a humongous super pool. And then that's not even counting Stan, Australia's answers to Netflix, which makes $50 million a year and growing. You can't tell me that business is not worth at least $500 million. And after all of that, you're still left with Channel 9, which older people still watch, and 9 Now, which younger people still use to stream TV shows like Married at First Sight, which I know, Sean, is one of your favorites.
Love Island, Brian, Love Island. My kids
Love Island,
of course.
Island, you know. Of course. How did I forget that? So when you look at all of that, you can easily say, take out the Domain stake. Rest of the business is worth much more than $1 billion that the market is attributing to. So that's an example of a sum of parts valuation in action.
I suppose the question then is, why doesn't Channel 9 split itself up then? Like, if you can only get $2 billion of value on the share market as one big organisation, why not split up? And maybe there's an argument for that, Brian.
One reason is because they're, averse to spinning out things at asset value lows when people's sentiments are at lows, and they just don't want to sell off things at bottom of the cycle. And right now, it is bottom of the cycle in terms of the advertising market and in terms of people's sentiment towards Nine generally. I mean, we've had news stories about how there is some cultural issues in that company. So I think companies need to be very careful, willy-nilly, breaking up companies just to appease the market. I mean, they do need to do this and be very careful about extracting full value. So I think that is one. And secondly, I do feel that if the advertising market the cycle does turn, I think sentiment will turn around very quickly, and they will be able to sell these assets off at much higher multiples than if they try to do it right now.
So sum of parts valuation, I often think about resource companies like that. And we know late last year, Rio Tinto pushed very heavy into lithium, particularly in Argentina. They've got big exposure there. They've got iron ore, obviously, in the Pilbara, plus a bunch of other commodities. When you're valuing resource companies, do you do it as a sum of parts valuation? Because you might have copper, you might have iron ore, you might have lithium, whatever, or are resource companies just valued as what we think their earnings are going to get because that's what they told us last time?
Well, Sean, I'm not quite as closely tied to resources company, but I can tell you for a fact that many analysts, when they value resources companies, they do value according to the commodities that they have. So, as you say, if a company has iron ore and copper, they would say, okay, let's isolate the iron ore part of the business. How much profit do they make out of it? And let's put a multiple on that. Oh, what multiple should I use? Hey, let's choose BHP or Rio. And then the copper one, they'll do exactly the same and say, okay, let's not choose BHP or Rio because their copper exposure is not as big. But there is that other company that's got a real big copper exposure. Let's use that. So it is a very common practice for commodities or mining analysts to use their sum of parts to justify higher valuations for some of their stocks.
Fantastic, Brian. Thanks for your time today.
Thank you, Sean.
That was Brian Hand, Director of Equities Research, Australia New Zealand at Morningstar. Remember to get your own independent advice before making decisions. This is Fear and Greed Summer Investing Series brought to you by Vanta. Vanta automates compliance for frameworks like ISO 27001, SOC 2, CPS 234 and Essential 8, saving time and money while building trust. Join over 8,000 companies like Atlassian, Dovetail and FireAnt managing real-time risk. Get $1,000 off at vanta.com/fear and greed. I'm Sean Aylmer. Enjoy your day.